This is episode 160, and we have a very special guest. His name is Jason Perro. So he was born and raised in Erie, PA, and attended college at nearby Westminster. After college, Jason began a sales career in pharmaceutical and medical device sales. He started his real estate investing career in 2001 when he and his wife purchased their first duplex. He built a portfolio of real estate rental properties while working a career as medical sales representative. He was able to leave his job in 2012 as the portfolio grew to nearly 300 units. So Jason balanced the demands of a high-pressure sales environment, a young family, and growing a real estate portfolio. Upon leaving his day job, Jason continued to build his real estate holdings and currently owns around 900 rental apartments. He's the president of his local landlords apartment association and a frequent guest on a podcast and occasional speaker at real estate investing conferences. Jason enjoys coaching and mentoring both seasoned and beginner real estate investors. He continues to grow his real estate business, but enjoys spending his time working out, traveling, relaxing with family and friends, attending sporting events and concerts, which is a great time for those relaxations, traveling and working out, time for pieces right now. So, and of course, you should and get in contact with Jason. So there will be a phone number for that, email, website. It's called perrorealestate.com. LinkedIn, Instagram, Facebook, everything and more is going to be on the show notes. But for you, Jason, I want to say big thank you for coming on to this episode today.
Well, thank you. Thanks for having me. I'm happy to be here.
Thank you. I really appreciate it. I mean, it's as we spoke kind of before I started recording, a lot of uncertainty. So I'm very happy that you're coming on today, and I'm sure you give us some hope, inspiration, and a right message and approach on real estate investing. So personally, can you give us kind of, your personal background and, transition into real estate and, because again, you've been doing that, kind of still having a full-time job. So how did you manage that and how did you transition full-time into it?
Sure. Well, first off, I'd say I think I took a lot longer to go full-time than I would have had to. I think we, just had this dream of walking away from our day jobs, my wife and I, and never knew any different. 20 years ago when we started in the business, there was no Facebook, the internet was there, but there was no YouTube. You couldn't, right now, all the information you need is at your fingertips. And we did it all ourselves, just saved up money for down payments and did it without any partners, no syndicating at the time. And, which I don't regret because I feel like we put a lot of our own skin into the game. We really did a lot of that ourselves. And, the challenge, which kind of helped shape who I am now and how we go about our life and our business is, worked in a pretty time demanding type of job. So in medical sales, I was going into the operating room with surgeons, selling medical devices that they would use in surgery. And so there was corporate pressure from that. They wanted you to sell so much product and then pressure of, being a resource and being valuable to the surgeons we worked with so that they would continue to use our product. So there was a lot of time spent there. Had a young family at the time. So there was, my wife and I were married for a few years, started having kids. So there's all these, demands at home, demands of the job, but we had this dream of buying enough property so that we could, in turn, have that freedom and walk away from the day job. So it was like a ton of sacrifice early on. It meant, when we were early on in our marriage and buying properties, some of our friends would be taking the nice vacations and they'd have a huge house and they'd have, brand new cars and things like that. And we just, we lived on one person's salary. We were accustomed to, like a college budget, where we were eating pizza and rice and, rice and beans and kind of not an overly expensive lifestyle. So we funneled every bit of money we could into our real estate investment business over those first several years. And I don't regret that. I mean, now I know that, you can, partner with people, use other people's money, you can syndicate, joint venture, you name it. But we sacrificed and we did a lot of that work ourselves early on. And that became really valuable, now almost 20 years into it, We know what it takes to when times are tough. We know what it takes to do things on a shoestring budget. And we don't forget that even as we're going into bigger properties and larger projects, but we also feel like, hey, we've earned, a lot of that sacrifice, we've earned that ability to, to do the things that we really want to do. And we're, having a great time at it and enjoying life now. And, I think one of the big things we, sort of learned early on was just constant growth, and at one point that just meant buying property and doing deals. And to some extent it still sort of is, but it really is just about growth, a growth mindset and learning new things and learning how to be a little bit better every day. So that's kind of what it took. And it was a big adjustment leaving that day job. Everybody wants that ability to leave the 9 to 5, but for me, for us, it was a bit of an adjustment, learning how to be our own boss. And that was, really didn't get comfortable with that for a while.
Yeah. And I love it. Beans and rice,
Yeah.
we kind of can laugh at that at the moment, it wasn't funny probably at that time, but when you look back at it, it's like, man, it's been funny, it's been a journey. And, there is a quote also, because I told you one quote, before, and the quote says, pay the price today so we can pay any price tomorrow.
Yep.
So basically, and that's what you're living, I think, by that kind of quote and by that rule. You observed and saw your neighbors buying the houses and the cars and living the life of traveling places, and you kind of frugal and investing back into yourself, into the businesses. So, and that was, again, you started your career 2001, so where you bought kind of your first duplex. And of course, maybe if you expand on that, I think it will be kind of good for people as inspiration. But just a like topping on that, 2000 was the .com boom. Like you went through 2008, came out, 2012, left your job after 2008. So that's kind of crazy, So, but talking about the first duplex, can you tell your story? How did you find it? How did you close it? Purchase price, all the good stuff.
Yeah. So when I read Rich Dad Poor Dad, Millionaire Next Door. I grew up, I didn't grow up poor. I didn't grow up rich. It was just, kind of lower middle class existence, and didn't really learn about money. And so I didn't know what I wanted to do when I graduated college, but I knew I wanted to make money. And so I had some sales jobs, and I started learning about making money. And, this idea of real estate seemed to be the vehicle, in reading Rich Dad Poor Dad, that was the vehicle in my mind for freedom. And so after I read that, and was learning about investing, talked to a lot of, people, like friends of the family, and people that maybe like my parents or grandparents knew. I said, hey, do you know anybody that invests in real estate? And, and I talked to a lady who was friends with my grandparents who were my grandmother was still alive at the time. And she said, she must have been like 85 or something at the time. She said, you don't want to do real estate. You don't ever want to deal with tenants. Don't ever do it. and then I didn't listen to that. Obviously I talked to somebody else who, he's since retired. He was an IRS agent, and he had maybe 40 or 50 rental units with his brother-in-law, who was a school teacher. And they seemed to, both have like really good lives. They had, at the time I thought, hey, these guys seem to be living a good life. And they had, rental property. And he said, well, if you're interested in getting into property, I have a property I'll sell you. So, of course he sold me his worst property. It was a $32,000 duplex. Now in Erie, PA, the prices are really low, but it was $32,000. I was, 23 years old. And so, it was the first $3,000, $4,000 I had saved up working at a day job. And I used that as a down, 10% down payment, and, had two, it was rented out at the time, and needed a lot of work. And over the years we had improved it and put the work into it, and actually sold it this past year. But at the time I looked at it and said, wow, I'm making enough cash flow on this to pay one of my student loans. It was like one bill. And I thought about, so, oh man, I got to do this again. So we saved up really, like over the course of the next year. Then a year from that, and then my wife was started working as she graduated college. And, we had enough down payment for 2 properties. So we bought a 2-unit and a 4-unit from them. And I'm like, wow, now I can pay like 2 of my student loans and a cell phone bill or whatever it was at the time. And so we just kept going down that path. And then, started making more money, getting better jobs, earning more income, just growing our base of property, building our cash flow, and just putting everything we made in that business back into the business, but also, investing like our hard-earned dollars, in terms of down payments and things like that. And then '08 hit, and, we started doing the Burr method before it was called the Burr method, buy, rehab, blah, 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 repeat. And so, but there's all these properties that when the housing crisis occurred, I'm like, wow, we have a line of credit or our own cash. We can go buy these, renovate them, rent them out, refinance, and then repeat. And so we did a lot of that during the economic downturn. And then, there were several booms and busts, quote unquote, during the last 19 years. But we just always sort of looked at, where to find the opportunity, no matter what's going on in the economy, and have always nurtured relationships with individual mom and pop owners that, maybe they own a couple duplexes, maybe they own, 100-unit complex. But over time, you want them to become, you want to become their first call when they decide that they want to sell their property. So we did a lot of that, a lot of building relationships with brokers, so that, you don't have to force a deal, so that when they have that deal, they're going to call you. And so that's really fed our deal flow really well over the years, is that, building, working out and building those relationships. And that's not like hey, I'm going to buy you a cup of coffee, now we're best friends. That's like, an ongoing, a long ongoing process. But, but that's kind of how we started and how we continue to grow.
Here you go. Yeah, definitely. So I love the fact that you're playing a long game. Like, you don't come in here for a year or for the two, because you understand it will be a long game. And, I don't actually talk a lot of quotes on the show, but it sounds like it's going to be a quote show today. So I think, it says, like, real estate, you don't get rich quick, but you get rich for sure.
Mm-hmm.
So, and definitely you have to play the long game. So I think that's a great strategy, because there's a lot of people that are watching this episode, and I'm sure they kind of generation, Z probably type of people, or maybe older, kind of my age, or, millennials, or, maybe some older people as well. Because everybody, it's kind of good for everybody to get involved with real estate. It doesn't matter how old you are, how sophisticated you are, there's a learning curve for everybody.
Yeah.
So, but I love the fact that, you're playing that. So again, the question that I want to ask you, 20 years and continue to build a business, how, it's kind of, relationship question, how people cannot kill themselves amongst husband and wife while building this business.
Well, you might get close a few times. I mean, it's, I mean, honestly, I mean, we, my wife and I had, early on, we were doing it all ourselves. I mean, I had sold her this dream of like, hey, look, we're going to do this. We'll get rich and we'll have this great retirement. And then, finally kind of realized I didn't, you don't have to delay the gratification. You can live abundantly now. You don't have to wait until you're 60 or 70. But you have to have some sort of sacrifice. If you really want to get from point A to point B, if you're starting from nothing, I think it is good to build that nest egg, and it's wise to do that. And I see some people that have, guys and gals that I know, locally, that they just so anxious to leave their day job and have that freedom. So look, just put a timeline to it. Is it 10 years of sacrifice, 3 years, 5 years, whatever it is, but get your spouse to buy in. If you're doing it and your spouse or significant other, or, and if you're single, your future, companion, if that's how it's going to be, you want to make sure that they understand that sacrifice, and it shouldn't be a 40-year sacrifice. I mean, I think that was like some of our parents and grandparents' generations, that, hey, you work really hard for 40 years and then you get a gold watch and, sail off in the sunset. But have a little bit of sacrifice. Your spouse has to buy in, and they have to understand that, I mean, there might be times where, you're working crazy hours and what you're doing is for the family, but you do need to take some chips off the table. I think when you are in that mode of sacrificing and really grinding to build the, build your business and build your freedom, you have to show not only your significant other, but also yourself, what that freedom really looks like. And, we really didn't take a proper vacation for a long time. We were just obsessed with money, and that's like not necessarily the right thing to do, at least for me. And I think, and for a marriage, and it can't all be about dollars and cents. You have to have some substance and have some soul there. Because if it's just about money, you're just going to be chasing. It's this endless pursuit that's never going to really bring you fulfillment.
Mhm.
So I know this is a long answer, and I apologize. I kind of
No, that's fine. That's a good answer.
But it's like, I think anything, and I mean anything in marriage, you have to make sure your ideas and goals are aligned. And if you're having a growth mindset, with your spouse, I mean, if you and your spouse are the type that are just going to go punch a clock for 40 years, and you're getting into this business where it's going to force you to grow, that may be very difficult. And so, I think that, and most healthy relationships do evolve. You're not the same person, or you may not view the world the same way when you're, I'm 43 now. I mean, I'm the same person, but I think, I've hopefully learned a few things, in the last 43 years. And so I think that it's that constant evolution. And so, you have to be able to communicate with your spouse. You have to be able to unplug, so even though you're going to go, 100 miles an hour, you have to be able to say, you know what, I have to have some like non-negotiable time with my family, and really stick to it, and we were joking around. I mean, this past weekend, my wife and I were both, and we're watching TV, and we both have our laptops doing work. And I was joking around, just said, some habits, like it's a bad habit, and we've done it for 20 years that we've been together. Just at night, we're working on our laptops, and sometimes you just have to shut it down and be together, and really, like, and really do it. You're not doing this just to build wealth, because like, you're not going to, I mean, that's great, but you're not going to take it with you, and so you're doing, so you build a strong why. And if whether that's leaving a legacy, creating freedom and opportunity for your family or friends, less fortunate, whatever it is, but having something, having that collective goal, like, and not just being it as words. Like, if you tell your spouse, well, I want this ability from real estate so I can travel the world. But, a lot of spouses aren't going to wait around for 40 years to do that. So, you don't have to do that today, but you should do those things that show what it's all about, okay. Like we're this is around Thanksgiving time. I don't know when you'll air the episode, but we're going on vacation for almost 2 weeks, and really just trying to, do it upright for our family. And we're taking my parents, and we're taking my wife's family, and some friends along with us. And and it's not lavish, I mean, it's going to be really nice, but it's not to, it's not nothing that's going to go on Instagram or Facebook, but taking that time, because that's the most important thing that you have, is time. And that's what real estate gives you, is that it gives you time, which is time equates to freedom.
Mm-hmm. Exactly. So I love what you said, buying a gold watch and sailing into the sunset, and that, talking about painting the picture right there, so, and it's been 40 years, what you're saying, for our generation, for our parents, and for you, it's been 20. So you cut it in half, and you probably go now even faster. And of course, it's all due because we probably missed some information there. Most of the time, it's all about, look, for me, it's very easy. Information and decision-making process. That's what it is, like it's fair. Life is fairly easy. Business is fairly easy. And that's what it comes down to. Like 80% is, mindset, 20% is mechanics. So, but, like with the time that's been given to you, I mean, to do that, what you accomplished like in 20 years. And again, I want to follow up with a question, because you kind of self-own all the properties, or majority of the properties.
Right now it's about half. We self-own about 550 units or so, and then we've syndicated the balance of that.
Got it. Because I see the interview topics, and I love when guests make it easier on me, because I love to roll without the questions. But, it's a very interesting one, because you talk about self-owning and syndication, because yourself, there's a lot of kind of brand new syndicators got involved or getting involved right now, maybe less now, in multifamily space. So what would you recommend for people who are looking to kind of transition from having a full-time job because they're uncertain what's going to happen with the future with their jobs? What would you consider to kind of pursue the syndication, or kind of take it slowly but self-own?
I honestly think it's good to have like treat every, I guess, let me back up a second. I think like maybe to treat every type of real estate investment as a tool in the toolbox. And so, some people really love wholesaling. Some people love flipping, buying and holding, single family homes and duplexes. And then some people love syndicating. And you may have one technique that you really love and that you're really good at. But I think with somebody starting out, I would think, try to learn about everything and see where see what pulls you in. So some people are just naturally geared towards flipping and they can make a fortune. Now it's still work, right? It's not, passive in a sense, but syndicating is work too. I mean, there's anybody that thinks it's easy. If you're going to quarterback a deal and be the key sponsor on a deal, you have to organize not only the limited partners, and the investors in the deal, but you're going to have to herd the kittens on the GP side of things and make sure that you can execute on a business plan. So, it's not the hardest thing in the world, but it's still work, if you're going to be the key person on these kinds of deals. And you can be part of a team. So I think the biggest thing is, go to conferences when things open back up and there's actual places to meet people and network again, but just try and network and meet people and really see what type of niche in this business you gravitate towards. Because honestly, some people, they could own 30, 40 houses, single family homes, with no debt on them and probably make more money than somebody who owns, 500 units that they have partners or syndicated with. So, is the goal to have, say you own a bunch of doors, because that doesn't really mean anything. What means, the important thing, what means something is the cash flow, the money you have left over in your bank account at the end of the month. So I think, find that vehicle that's going to get you there, and don't be afraid to do a little bit of everything. I know some gurus out there will tell you to, just, forget all the small stuff, just go straight towards the 1,000 unit property. And that's terrible advice to somebody starting out, because, number one, just because you can do this, like, let's say a 10 or $20 million, $50 million deal, doesn't mean that you can operate it well. And the rewards are huge, but the mistakes are much larger. And so I think, you should always push yourself out of your comfort zone, but, start small, start with a couple duplexes, start with a 20 unit, 10 unit, whatever makes you a little bit uncomfortable, and then go to a little bit beyond that and a little bit beyond that. But if you're not comfortable and you're not sure of yourself, your investors are going to know it. You might just go too far, too deep. And honestly, like, you're going to, like, somebody might say, hey, I want to own 1,000 units in a year. Well, that's a great goal. But, how about just acquire a ton of knowledge, take action on whatever the deals look like. Maybe you become a member on the team, a team that's syndicating deals. Maybe you're flipping houses. Maybe you're buying a couple properties on your own. You can do all of those at the same time. So I think anybody starting out, honestly, just try and push yourself out of your comfort zone and learn some of these different techniques for investing in real estate, and see which of those brings you joy and the most fulfillment. Because no one of them is a silver bullet to all of your dreams. You got to do a little bit of everything.
Mm-hmm. That's it. Yeah. And that's great advice. I love the fact that you said not going into 1,000 unit, from a kind of the get-go, from the start. And, with all due respect to some gurus, there's, some gurus are really good out there, but I think the problem is, what you're saying is, that those gurus are looking at other people through their personal lenses,
Yeah.
And what I'm saying, they thought, look, I became kind of rags to riches story, but that's them. It doesn't mean that there's going to be everybody who comes to their training.
Right. Right.
So
and we all have, we all have our own life experiences. Right. And then I think that just because, some people may want to go out and own 10,000 units, but if you're doing that to be a mogul in business, then great. You've checked that box and that's what you're doing. But if you're trying to go out and buy 10,000 units to buy yourself some freedom, I don't know. I don't know what that looks like. I mean, we all have our own different goals, and you know, I have a good friend that you know, he's you know, he has about 100 units, splits his time between, you know, Erie, PA. I think he's finally moved. He's actually in Florida 100% of the time now, but travels the world and does whatever he wants, and has a, you know, has a family of 6, and they don't have that big of a you know, they don't live too high on the hog, so they don't have that much of a you know, a lifestyle expense. So they, you know, it works for them, and they're happy, and that's what it's all about. So yeah, it's just, it's do what makes you, you know, like, you know, look at like what the gurus sell. I mean, I think it's important to find that training and listen to people who have been there. They certainly, like, these are like fundamental truths that have been around since the dawn of time. A lot of the stuff they talk about. I mean, like you mentioned, you know, 80% mindset, 20% mechanics. If that's all you get out of going to a conference is the mindset, then you know, find who you resonate with and listen to them, because a lot of these guys are selling the same thing. It's that mindset and trying to get you to take action in the business. So, you know, find that, try and follow some people that can inspire you, but don't be afraid, you know, to put your own spin on it. Like, we're all different. You know, you don't have to follow this person, that person, or the next one. Create your own path and your own roadmap, and you're going to find much more contentment and satisfaction in that.
And that's a very good advice. That's a very good advice. Thanks for sharing that advice. So coming back to kind of the personal stuff and the way we manage ourselves and, you know, manage our businesses and life. So that's the question that I see one of the topic is life balance, you know, because it's kind of one of the important pieces when it comes to our personal lives and the way we, you know, conduct businesses through managing, creating time. So can you take us through, let's say, through your personal and maybe routine, if you don't mind sharing that, you know, let's say you're actively looking for deals right now. Let's say it's going to be your first deal. So what your routine is going to look like? You're going to journal in the morning. Do you have some sort of a, you know, priming or routine? Like how your day is going to look like?
Yeah, so I'll be honest. I tried to in the past to set myself like on, you know, on the, you know, these, like wake up at 4 a.m. and just do all this crazy stuff, and it doesn't work for me. You know, I need my 8 hours of sleep. So that's how I prime myself, is to make sure that I'm getting plenty of sleep. Because, you know, if I get 5 hours of sleep, I'm not nearly as high functioning as when I get 7 or 8. My wife always jokes with me, she doesn't need that kind of sleep, but I do. And so I'll go to bed earlier. Not that early, but I'll go to bed early and try to get a reasonable night's sleep. You know, my routine, I try to, in the morning, I'm always trying to get my kids ready for school. That was the big thing for me leaving my day job, was just doing the things I want to do. And I wanted to be there to take the kids to school in the morning. And you know, I get my, you know, my mind right by then going to the gym. So I'll typically go to the gym after taking my kids to school. And for the most part, I try to make that a non-negotiable part of my schedule. Just, you know, I mean, I certainly have my bad habits. You know, I you know, don't always eat the way I need to and things like that. But I try to get the blood flowing and try to, you know, try to have some focus on health in the morning. And so I usually find that then I work much later though. So instead of getting up early, you know, that primes me. And then by mid-morning, I'm ready to kind of touch base with my team, make sure that they, you know, they've gotten their day started. I know if there's any issues that I have to be involved with, and then I don't want to be, I learned this from, I think it was a Jim Rohn training, but back in the day, but he had said something. It was like, he implemented like the 3:30 or the 4 o'clock rule. Like, don't bother me with anything until 4 o'clock. And what it does is it forces your team to figure out the solutions to the problems they're having, and it empowers them and just makes them that much more effective. And when I learned to step away and really, you know, see the results of delegating, made my life that much easier. So, you know, mid-morning, quick touch base with my team. And then I usually have phone calls, meetings, you know, now Zoom meetings, you know, not as much lunches while things are shut down, but, you know, I'm talking to, you know, investors, you know, people that have invested in deals with me or looking to invest in deals with me. I'm talking to sellers, you know, individual owners, talking to brokers. So I'm just generally looking at like my deal flow, but also looking at the things I want to sell. looking at the properties that we're trying to offload. So that's a part of my day. And then, I usually save my journaling for the nights and the weekends. I'd love to be able to journal every day, and I have in the past, and then I sometimes kind of falter on that. But I've got stack of journals and I believe journaling is one of the most important things for me. So I'm always writing my goals, mapping out. I usually try and map out my next 3 to 5 years, and then reverse engineer that down to the next year. So I'm constantly just like tweaking my goal for the year until I get to the end of the year. And usually about 2/3 of the way through the year, I'm working on next year's goals. So I spend a lot of time journaling. And then out of that, I create my task list. And so those things that I'm doing from like mid-morning to mid-afternoon is usually a result of the tasks that I've created or realized from journaling. And some of the advice I give the most, and I try to follow my best to follow, is, you seldom do more than 3 things really well. So I try to just to have 3 priorities for myself in the business. And I look at those as the revenue generating activities. Aside from the day-to-day, I mean, the management, of the business. I mean, my property managers are generating revenue, but I'm talking about the big business side of it, on the acquisition side. Other things we're involved with. Just so focusing on those activities that would generate revenue for our company. That's where I try to. Those are the areas I try to spend my time. Those 3 top priorities. And if there's a deal in the mix, that might be raising money. That might be working with somebody on our team who's training them on how to raise money better. Things like that. But then by mid-afternoon, I generally will pick my kids up from school. At least half the time or more often. That was something I always wanted to do. And my wife has a business of her own as well. So we kind of juggle that, but then I'll usually come home or go back to the office and kind of do the end of the day touches with the various managers and stuff in our company. And then, we kind of break in the evening and have family time. And sometimes that's just everybody on their devices and sitting in front of the TV, but try to break away from the business. And then I'm usually back into it mid-evening, just, kind of, going through, usually journaling and spending most of the time working on goals and journaling and creating that, like what are going to be the highest impact things that I can do to drive revenue for myself personally and for my company.
Love it. So focusing on 3 revenue generating things.
Yeah.
So that's good. So, I mean, it's a good routine. So anybody who's watching or listening, take some notes, make sure to do that. And of course, kind of try to make your own personal recipe, because everybody who is watching or listening, kind of living your own life, and you do things maybe a little bit different. Some of those may be kind of the same, getting up in the morning, brushing teeth, but the rest is kind of, you may be different there. So make sure to do that, because having a routine is part of the success for sure. So before we're going to move into your personal portfolio and talk about some deals, because I know you're talking with a lot of people, again, when it comes to coaching and mentoring that you provide for the people to kind of teach them how to get involved with the real estate business, how to build one. Let's say if we're going to look down 1,000 feet kind of overview, like when you meet a potential person and you're talking with them, what would be kind of the traits that for you that stand out that that person is going to be successful real estate investor?
I think a couple of the things that really stand out, number one is curiosity, a willingness to learn and grow. If you just see the world in absolutes, without gray area and without the ability to grow, you're going to have a hard time in this business, because life and business are always evolving, always changing. So being able to adapt, being able to willing to grow, there's always something new. I mean, there are investing can be a really simple concept, but you have to be willing to grow. I think, willing to take action, calculated risk. So, some people can spend, fortunes on going to conferences, doing training, doing coaching, but if they're not willing to take action, then they just become a very expensive library. They're not out there taking action. I'm not saying go out and take action and put an offer on a $50 million portfolio if you haven't yet closed a deal, but that willingness to analyze data and make a decision. And if you make a decision, live with the results. And so Real estate's a very forgiving investment. So, you just have to decide and not let self-doubt get in the way. And I think the other piece, is being able to be humble. A lot of times you see people the minute they catch a little bit of success, they're flashing it all over social media and flashing it all over town. And I know, like, it's when you come from nothing, that can be tempting. And when we all have a chip on our shoulder, but at the end of the day, I mean, like, look, we're in real estate investing. I mean, I don't know, like, I have friends who are doctors and lawyers and other business people. You're not seeing them like putting a video of their Lamborghini on Facebook, so people can be like, oh, look at me, I'm a successful heart surgeon, I drive a Lamborghini. Like, that's not a thing there. It shouldn't be a thing in real estate. I think it cheapens the experience. I mean, it definitely will attract, some followers, because people see like the fast car and the pretty girls, and they want to be like that. But that's not, like, that's not real. You know what I mean? So I just think, being humble and being able to, because the thing is, you're going to get kicked down a couple times in this business, and you want to make sure you want to make sure you still have friends at the end of it. So being humble, being honest, and I think if you have those traits, and tenacity, because when you do get kicked down, you got to get back up and work through it, and that's the biggest thing. That's such a forgiving business, but you have to be willing to work through the challenges and enjoy the ride when it's going well too.
Exactly. So if you like, as I love the piece of when you said about being humble, because that definitely happens. And, we definitely, we want that financial freedom, and part of that financial freedom for some people, it could be a Lamborghini that they want to drive, but instead of maybe owning one, why not lease it? Because again, if you have a solid real estate business, you understand that Lamborghini is a liability for you. It's not an asset. So first of all, doing that, it could be a good thing. But second of all, if you just remember about the people, let's say like Elon Musk, at the same time, while you're bragging about your, 200, 300 units, property deal that you're having at cash flows, X amount of money, there are people like Elon Musk trying to fly to Mars and creating, Solar City and Tesla and the rest of the companies, the Neuralink and, all these different things. So it couldn't be even that, there's other business people in different industries who are creating some unbelievable things.
Right.
So, when you think that way, I think people are going to be good. So being humble, it's a big one. So again, talking about your personal deals, can you give us a little bit background, like where are those deals, 900 units, are located? Which states?
Yeah. So most of our portfolios in our backyard in Erie, Pennsylvania. And then we just buying our first deal in Cleveland, should be closing early December on that, which is a little over 100 units. And so I've got a couple more deals in the pipeline in Cleveland, actually working with a student, a real estate student that I do some coaching and personal development stuff for, likely partnering up in something in Arizona. So starting to branch out a little bit, but we never knew any different. When we started out, we just thought you buy property in your backyard, and that's how it went. We're thinking small and just, had, small goals, and just, we're happy with that and successful with that. So yeah, vast majority is in our backyard. And then, again, we started branching out recently. And so I like, as a rule, I think the, not looking for a high growth market, because I just feel like Murphy's Law, this like, somebody's always going to get stuck, like when the growth stops. And so I just like, the thing about Cleveland, Ohio, or Erie, Pennsylvania, and markets like that, a lot of these secondary and tertiary markets, is that, you're not going to double or triple your money overnight, but like you said, and you're not going to get rich quick, but you're going to get really rich, wealthy over time. And so go buy a property in Cleveland and just sit on it for 10, 15 years. And you know what, at the end of the day, you're going to make a really nice profit, and so I think that's the nice thing is, though, too, in markets like that, where, we're not really pushing the rent, pushing that envelope where you're really getting overly aggressive. So when there's a market downturn and things are crazy, during these COVID times, we're not feeling a compression on the rents, because we're still in this, so even on the higher end stuff we own, we're still able to fill the units with good people and paying tenants. and it's not like where we've pushed that envelope so far that it can't go any further. So that's been, to me, like any market like that can generally, I mean, this is generally speaking, I'm not speaking from data, but can do well over the long haul. But if you get, somewhere where it's really hot, you might just get stuck when things aren't progressing as fast, and that's sometimes hard to time. Nobody would predict it a year ago. Nobody would predicted a pandemic, and it'd be interesting to see how some markets do from that when it's a year from now, and things are starting to get back to normal. How are they doing economically?
Exactly. So Pennsylvania, good, because before I had only PA, and I get all the time I get confused with all these letters, because again, I'm not from state, so I don't know Pennsylvania and Ohio. So here we go. So that's good to know. So again, talking about the deals itself, like because you mentioned, first of all, like what is the smallest deal? Because you got rid of the duplex that you owned almost for 20 years. So that's good. So what is the smallest and the biggest property that you have currently in the portfolio?
Well, we still have some single family homes and duplexes in the portfolio. We are selling those off. I've sold some things off where I'm the bank, and I'm collecting a check every month, and we have some that we're selling outright. So we are in that process of selling off the smaller stuff. The largest property right now is a 205 unit. We own 127 unit, an 86 unit, 77 units. So there are, it runs the range, but ultimately, within the next year, we'll have sold off everything that's 16 units and smaller than 16 units. So 16 units at that time will, if I sell everything, all the small stuff off, will be 16 units and above.
Mm-hmm. So what is the future strategy that you're looking to do? Are you planning to acquire more kind of multifamily syndication deals? Is that what your strategy going to use in Pennsylvania and Ohio, or is it going to be something else?
Yeah. No, I really enjoy the syndication model, and I like, we love Cleveland. I mean, it's only an hour and 20 minutes up the road from us. So it's nice to be in something so close to home, but having, again, strategically placed in different markets. So like I said, I'm probably going to sponsor this development deal in Arizona. So doing a handful of very strategic, profitable deals per year, as opposed to just accumulating massive smaller properties. So I think we're very fortunate to be in a place where we don't have to do anything, but we're still continuing to grow. And so whether that I think for us, we'd like to do some ground up development. I'd like to get into different markets with good operators or good syndicators, and we bring a lot of experience to the table. So 20 years of not just self-managing and owning, but also syndicating. So for the last few years, so I think we can bring a lot of value to those teams. So really enjoy that, and I have a limited number of coaching and mentoring students, and I love that educational piece of the business. I love that ability to kind of give back, but try to limit that, because that could be its own. Those things can create a mind of their own and take a lot of time. So trying to be very intentional with how we're spending our time, and so we'll continue to do deals, but continue to enjoy life and spend time vacationing and traveling. And when we get back to concerts and sporting events, I'll go to those again when.
Yeah, definitely. So besides looking at the development deals, as you mentioned, in Arizona, and doing more of that in the future, and of course maybe we can go a little bit in details why doing development in Arizona, in that particular state. So can you talk about your investment criteria, like what type of deals are you looking for when it comes to multifamily?
Sure. So I generally look at, I want to be able to deliver my investors, and if it's my own money, I'd like to deliver, again, this is generally speaking. So, I mean, everybody's obviously, every deal is different. Development deals are different. Repositioning deals are different, but just for a standard type of deal, we'd like to see some meat on the bone. So meaning that, there's value adds a tricky word, because everybody thinks they can create value somewhere. And generally we can, but in the middle of a pandemic, I think this is the stress test. Like how far can you push rents, and how much value can you add during an economic downturn? So I think for us, it's knowing that we can provide some value in the deal so that we have this, some exponential growth along the way. But the deal shouldn't hinge on that. I think my worst case scenario should be that we can walk in day one, be able to have a reasonable return on our investment. So generally a minimum cash on cash return out of the gate should be 7 or 8% for us. Mm-hmm. And so I'd like to see that. I'd like to, that's kind of the minimum, because I know if I have an investor that they're going to want to see 8% cash on cash. I'd like to see, again, we'd like to see some upside, and I don't have that. That's not that hard and fast of a criteria, but that's really the biggest thing we look for, and that it's in generally a C or B area. Again, with room to grow. I mean, A areas, it all depends. It really all depends. I mean, I own, A, B, and C properties, so everything's a little bit different.
So A, B, and C, you're talking about the location, not the properties itself. Correct.
Yeah. Oh, the properties themselves too. I mean, we own a little bit of each of those too. So, So areas and locations. So it's mostly for us. It's mostly B area, B location. That seems to be, where we strike gold is with that type of. And C's can do really well as really well also. C area, nothing wrong with the C area, but if you're selective and you pick up the right kind of property where there's room to grow, you can do really well, and as long as you manage it well.
Not the D. Nobody wants the D.
Right. No,
the D is yeah. Okay, got it. So
don't make those mistakes.
That's a mistake, right? So being in business for 20 plus years, again, and you talked before, kind of building that relationships, and you got some calls, and probably a lot of calls maybe during these times from, property owners. So probably kind of mom and pop type owners who are calling you and saying, hey, listen, I'm looking to sell off my property, and maybe you can negotiate kind of good terms on those deals. So is that how you kind of, when it comes to a personal pipeline, is that how you get the deals currently now, or most of the deals that you get kind of BC through the brokers that, do you build the relationships with?
Yeah, it's a little bit of both, honestly. I mean, we, the out of town deals we're doing, I mean, it's really, that's strictly through brokers, but, having met a lot of people if it's a local in our market, I've met a lot of people. I mean, my position, president of our local investment group, it represents 1,600 investors, landlord investors. So, we have monthly meetings, and I run those, and I've been on the board of that for 15 years. So we generally get 100 to 130 people at those meetings. And so I think anytime you have a chance to network with people, that's great. So you meet somebody and you follow up and offer them to buy them lunch or coffee, and you build that friendship and that rapport. And so you want to be on their short list of people to call when they decide that they want to sell their property. And so, so I don't often go into that with like, hey, I want to buy your property. It's sometimes if you can just approach them with trying to learn a little bit about the business, and you can always tell them that, hey, look, I'll if you ever want to sell, I'll think of me. I'd love to buy your property. Someday they will want to sell. It could be 2 weeks from now, it could be 15 years from now, but you want to be that person they think of when they're ready to dispose of their property. Exactly. So that's always been some of the best deals that we've gotten, because whether it's owner financing, whether it's just they're selling at a lower price because the properties need work. Those deals tend to be some of the best ones we've done, just because of the ease of getting into them.
Exactly. So again, if you're coming through, let's say, mom and pop top owners that, calling you and saying, hey, listen, I want to sell off my deal. Like those deals that we're talking about, let's say in Pennsylvania, in your market that you can actually drive, and, that's not off, not kind of, the markets that like Ohio that you have to drive off, and that's coming through, broker relationships, but the local market, so when you get across those, like deals, do you sometimes say no because it's that bad, or do you still take on those deals if it's like BC and it's kind of question within the question, but like, do you do like a heavy facelift on those deals? Like how much do you actually spend, let's say, per unit on, renovations and value add strategy? Are you using kind of a cookie cutter approach when it comes to those value add strategies? Or it's based on a deal to deal basis?
Yeah. So I mean, the quick answer is everything's on a deal to deal basis. You know, I had a bank that I deal with bring me, it was like C&D property a few years back. And it was like 37 units and multiple a lot of singles and doubles. And you know, but they were willing to give me the properties for the debt that was in place on them. So I ended up flipping but we repositioned all of those properties and sold them to other investors, and we hold the paper on it. And so was able to do a couple things with that. I was able to create additional cash flow in our business, but also I didn't have to go in and do that heavy lift. But I was able to bring a product to, you know, rehabbers, you know, guys that wanted to go in and do the BRRRR method, but having the flexibility that I wasn't going to I wasn't charging like, you know, super hard money rates either. You know, it was a reasonable deal. They were able to get in and have time to reposition the property. So I'd done a lot of that. It's a lot of work. And so now I was just a conduit for the bank to this other groups of buyers, and it worked out really well for all parties. But there's no there's no cookie cutter situation. I actually bought 2 20-unit properties within a week of each other, within a block of each other. And one was, and now these were near some other properties of the same size that I own in a really decent area in our city. And the one property was like turnkey. Every bit of maintenance had been done. The rents were, you know, where they needed to be. It was just straight up turnkey. The other property, almost identical, but the rents were like $200 to $250 below what the other property was charging. So I knew I was going to have to go in and do a heavy lift on that property, and which we've done, and we're almost complete with now, almost 2 years later. But now I have those properties in a strategic position that I can bundle those with the other properties in that neighborhood and do a portfolio loan of, you know, maybe 150, 200 units. And I can drop my payment to like, you know, a great place and save a bunch of money every month. So sometimes it's more of that longer game, like, hey, I'm going to pick something up because it would be a great addition to my portfolio. And then I can, you know, number one, then get long-term agency financing on it. And then, hey, 10, 15 years from now, I can package those properties up and sell those, to the right buyer, because they're great properties in a great area. So
there you go. Okay. So, and part of that business, you know, part of the multifamily business, you know, there's a lot of things that involved into kind of day-to-day operations. And part of that is, you know, the property manager. So do you have a vertically integrated company when it comes to managing these deals? So do you have a third party one for now?
No, we're vertically integrated. So having, you know, started out managing our own way, that's the only way we knew. I think, you know, if it's not possible to vertically integrate, you know, if you're buying properties, then you really need to have a partner or a property management company you can trust. But if you're buying on your own, I mean, one thing is you can always keep more money. If you're active at managing, you can always keep more money in your bank account by self-managing, if you do it well. You know, if you're terrible at it, and well, of course, you know, then get somebody else at it. But it's a great way to learn the business. It's a great way to learn your properties. I wouldn't recommend doing it forever, because it is time and energy intensive to deal with tenants. But it's good in terms of starting out and getting experience. But eventually, you know, you want to grow big enough that you can have staff to handle that. So for us, I mean, I have multiple property managers, multiple site managers, you know, CFO / accountant on staff. I have an office manager on staff. So I have all these people and staff to handle the things that I don't want to do. And that's honestly, that's the, you know, open secret is, I think a lot of us grow that started out so small. You just grow because you like, man, I'm tired of dealing with this crap. So you hire somebody who's better than you at that to deal with it, and they enjoy that part of it. And that allows you to do what you're good at, which is doing deals.
Yeah. I don't think it will be possible for yourself to manage 900 units. First of all, you know,
That's right.
you have to have somebody. It's either third party or vertically integrated, you know. And of course,
Yeah.
you know, about vetting potential property management. You know,
Yeah.
there's books and courses and, you know, all that information available. I want to ask you a little bit different questions related to that. But first of all, it's a great way, as you said, if you get involved with that personally yourself and you start implementing systems and putting people in place, you can kind of scale this business, create a, you know, separate, of course, it's going to be separate entity LLC, and you can, you know, take on maybe somebody else's operator, you know, units and, you know, manage their property. So you can scale that business as a business, you know, on its own.
Yep, for sure.
Yeah, and it's a great way. But like the question that I wanted to ask you, because there are people giving, you know, different advices, and I just want to hear yours when it comes to, you know, doing kind of taking vertically integrated property, you know, creating your own property management basically in-house. When does it make sense? You know, is it from a day one? Is it unit count when you reach a threshold of units? Like, because some people saying go and, you know, do your kind of third party, and somebody saying no, you should do your own because and you're doing
Yeah.
your own. But is there a number that we should keep in mind, or it's from day one?
Well, I think I mean, it all depends on your goals and where you're at in the business. I mean, if you're, you know, if you live in New Jersey and you're investing in Utah, I don't know how you're going to self-manage that effectively. You know what I mean? So I think it depends on if you're investing locally, you know, to your own locale, or if you're investing out of state. And you know, so I think that should be a really important factor in that decision. You know, you can do it yourself, like we did starting out, until we got to about, I don't know, it was probably 80 units. And I have a friend of mine in the business that he just, this year he got to his first 100 units, and he picked up his first employee. I sold him some properties, and he picked up his first employee when he got to about 80 units as well. So, you know, you can piecemeal and self-manage, quote unquote, doing some things yourself, piecemealing it until you get to a certain, you're going to realize there's a point where you need somebody out there just, you know, handling leases, doing apartment showings, doing things like that. So it might be in that, depending on how labor intensive the property is, maybe 50 to 100 units is when you need that employee. And it could be a hybrid maintenance employee / property manager. You know, I don't disagree with the argument that some people will make in terms of, you know, don't self-manage. You know, they have a point there. I mean, if you know, maybe you just then focus on really well on big deals and doing other things, and then you just live with whatever return you're generating off the property. But, you know, some of us like to, you know, like you might want to control the property a little more. You want to have your thumbprint on the business a little bit more. So I think that's, you know, it's like one of these like personal questions that it's really going to be right for you. You know, like I wouldn't recommend investing in like duplexes 300 miles, 500 miles away. Like, you know, if you're going to be investing out of town, you know, go a little bit bigger. And if you go really big in that market, you should spend a little bit of time there, and you could vertically integrate when you get to a point where you realize that you know, you're better suited to have somebody that you control their time, and that they're working, you know, for you most of the time. So really just a personal question, and just not being so, you know, dogmatic one way or another, you know. And so it's not necessarily an absolute, but you know, and I know that's kind of wishy-washy, but it really is different for everybody.
Yeah, exactly. It is definitely different, and it's everybody's personal decision what they want to take on. So last question on property management. Again, during the times, if you're watching this, it's today is 9th of November. So still doing the COVID 2020. So can you talk about when it comes to property management company? Because I spoke, again, I'm talking with a lot of kind of multifamily syndicators, operators out there. And some of those people saying that they came across, you know, this problem of, you know, people paying rent. So can you talk about how does your property management company goes about to make sure that those kind of rent payments go smoother, you know, for those people at current times?
Yep. So I think, you know, when the pandemic really started, like things were shutting down last early March of 2020. You know, I made sure my property managers spoke to every tenant directly. And I personally spoke to a lot of tenants as well, and just, wanted to make sure that they're doing okay. And, if we needed to work with somebody because of a disruption in their job, that we would set up a payment plan or align them with any government assistance that they would need to be able to pay their rent. So we've continued to do that. There was a lot of CARES Act money available for tenants that were who were affected by COVID. But it's really interesting because it'll show you who is just trying to scam the system. Because if they're ineligible for COVID, then that means they didn't have a reduction of income related to the pandemic. They just spent their money on things they shouldn't have. So which tenants, surprised, they will do that from time to time. So we try to we, as a rule, we've taken payment however they want to pay, cash, money order, check, credit card. We use a property management software. Most tenants will go online and pay online, and they can use a credit card, ACH payment through their bank, whatever that case is. But we try to treat people like human beings. I mean, we're not just hey, it's, your rent's late, I'm going to evict you. You try to at least get a feel for who they are as people and what's going on. I mean, if they lost a job or their hours were cut, can you work out a payment plan? Is there a government agency that can help them with their rent? And so if you're looking to hire a property management company, my advice would be, are they effective at generating collections? I mean, that was the thing, is we wanted to make sure we were working with our tenants and had the finger of the pulse on what was going on, so that we, we care about these people, make sure that we can align them with any agencies that can help them, because it's not just about rent. It might be help with utilities, help with groceries, one thing or another. So for the vast majority of our people, even if they had a temporary hiccup with their employment, a lot of these people are back to work, or they had no disruption at all. So collections have been really good. But for those that haven't, when they fall out of their normal rent payment pattern, some people always pay on the 5th, or some people always pay on the 2nd. Okay, what's today? It's the 9th of the month. But if you get to the 9th and their rent's not in, and we've reached out, and they've not gotten back to us, we might have somebody on our team paying a personal visit to the property. We really want to reach out and make sure that they contact us and let them know that, hey, look, we want to help you, so we need to know what's going on. And then we spend the time working with them to get help from any agencies that they would need. And ultimately, if they can't get that help, we don't want to necessarily let people live for free. So indicating, hey, maybe we'll let you out of your lease early. We're not going to pursue any financial judgment, but if you leave the property, we're not going to pursue this. We know it's a tough time, but try and work through that. And we've had a lot of luck with just again, working with people on an individual basis, depending on what their situation is.
Exactly. So overall, Pennsylvania and Ohio, is it more of a tenant or a landlord-friendly state?
It's kind of in the middle. It's definitely not overly tenant friendly, and it's definitely not overly landlord friendly. So, we have been able to do evictions. Everything was shut down, late spring, early summer. But midsummer, we were able to start evicting for, non-monetary reasons, they like actual lease violations, disrupting the property, whatever you can think of that would be a lease violation. And then this fall, they allowed, September 1st, they allowed evictions to, monetary evictions to occur again. Now, this federal guidelines from the CDC that indicates that we can't pursue financial evictions right now if they sign the declaration page. That's proved problematic on a few instances, because some tenants will just sign that and say, hey, I signed the declaration, you can't evict me. But we've spent a lot of time trying to figure out, well, you are signing this under the, and if you lied, that's fraud and that's perjury. So it appears as if the FBI is the one that will go after people that are committing fraud with this. Now, I don't know what'll happen, if anything will happen with that, but we try to make sure people know that there's consequences to just like we can't evict somebody if they actually need the help. Like, well, they're going to be. in trouble if they're committing fraud. You know,
Yeah.
we'll pursue that as well.
Definitely, definitely. Because before you just had a conversation with some other guy. I'll give you updates when we finish talking. But you know, it's going to be a lot of that happening. That's what the guest told me. You know, it's going to be more and
Yeah.
more fraud committed during these times because times are tough. And so for some people, the quickest way to do something is just, you know, do those type of things. So we have to make sure that as an entity, as an LLC, that we're protected, you know, against those things happening. So again, talking about kind of doing currently, like what you have in the pipeline, you mentioned kind of looking to get rid of the smaller deals and still continue to look for multifamily in Ohio, Pennsylvania, and doing some development in Arizona. Is it going to be development mainly, or are you going to be doing some redevelopment also?
Well, in Arizona right now, I mean, the project we're looking at would be a development project. So pretty much open to keeping, you know, if a deal makes sense, and it aligns with our values and our goals, and you know, and it seems, you know, a moderate rate of return for the risk involved. We'll look at anything. So yeah, I mean, I keeping an open mind to whatever comes our way, you know, and aligning with good quality people.
Good. So just a question about the development deal, because you already have it. I mean, going on, how big is the deal going to be?
It's about 100 units of container homes. So the person I'm working with has a long history of development and you know, and construction experience. And so there's this big movement of repurposing those shipping containers into, you know, 1, 2, or 3, even 4-bedroom apartment spaces.
That's interesting.
And yeah, and I started hearing about that. I'm like, that looks cool. Is it really feasible? You start seeing some of these popping up over, they look a lot nicer than it sounds. I mean, you say, oh, you're making a house out of a shipping container, but who would do that? But when you actually look at it, people are doing a great job with it. And really, you wouldn't even know, and in a lot of cases, you wouldn't even know that it's was made out of shipping containers. So,
that's
yeah,
happening. That's happening. I mean, if you ever been to Europe before, you know, the Netherlands, you know, that's happening in the Netherlands. And actually, you know, a lot of people like making office space and, you know, people living in those type of things. And I think you're probably going to have a lot of people coming in from California side to live in those.
Yeah, I think so. Well, it's, you know what it is, it solves a need where, you know, like if you're in California, right, like what's the cost of, the cost of buying a new home? I mean, it's ridiculous. And not all, but most areas, like a lot of areas in California, very expensive for home ownership. Arizona, a lot of areas are really expensive for home ownership. So here's a product that you can give somebody, you know, affordable middle-class housing without breaking the bank. And that, but provide a really nice, decent quality product. And so, you know, there's always the hard cost of, I mean, what does it actually cost to develop land or you know, create these homes? But I think if you can create somewhat of affordable housing, you know, you're doing good. You're allowing people to achieve that. So number one, if you're selling them and you can do that, you know, create a development where you sell these as homes, you know, you're allowing people to have that dream of home ownership. But on the rental side of it, you can still provide affordable housing because the cost of building these is much less than stick-built construction, you know, say going out to build a 100-unit complex. So it's interesting. So it gives you a chance to give people a little bit more affordable housing, but, you know, and make it kind of everybody walks out of the deal happy, the developer, you know, and the tenants. So I think it's doing good by doing good.
Exactly. And I love it. It's very interesting, kind of unique space. And I'm sure that there's probably some developers who are already kind of doing these container type of houses. And it's good because I think there's, like, I'm not from States, but as far as I'm aware, you know, by just talking with people, doing my own personal research, there is a, you know, kind of crisis when it comes to affordable housing. You know, and like one of the options is, of course, like container homes. Second option is mobile homes. But mobile home supply is very small. And it's like there's not a lot coming up through the year. You know, I think it's about the last time that I spoke, I think it's only 10 like mobile home parks are getting built every year, which comparing to multifamily or development space, I mean, it's nothing. And actually some of those mobile home parks getting torn up and, you know, on that land, they're building brand new A-class multifamily deals. So, I mean, there's definitely a shortage of that. So I mean, you at the same time you're doing that, and like solving some big problems that are people are facing. So that's very good. Again, so the last question that I have for you, again, besides what you're currently working on and building your business and impacting communities, helping people to start their own personal real estate businesses with mentoring and coaching, what is your personal legacy that you want to leave behind you?
Well, I think I want to leave. I mean, I think about this a lot, and somebody asked me this recently, and it took me a while to think about it. But I think the big thing is, leaving the world a better place. And so it's not about the money. I mean, money's the vehicle. Money's energy, but it's about trying to empower my family, my kids, my nieces, my nephews, that type of thing, so they can go out and seek freedom, but by doing well. And so if it were all to end tomorrow, you want to be remembered for the impact you had on people's lives. So being able to make a difference in others' lives. So that's why I love helping new investors, why I love working with meeting new people, just trying to be a positive impact in their lives, but through our investments making a positive impact in the communities that we're in.
Here you go. And today you definitely made a positive impact on myself and on the people who watched it and listened to this episode. And I definitely recommend for everybody who's watching or listening, get in contact with Jason. And again, phone, email, website, PeroRealEstate.com, LinkedIn, Instagram, and Facebook is going to be in the show notes. So get in contact with Jason and ask him questions about, the deals that he has in pipeline, the way you can invest alongside with him. Passively in the syndication deals, and ask the questions about how can you start your own personal real estate business. And I mean, there's a lot, even though in this, interview today. So I really appreciate you, Jason, for joining me today and providing all this value. It's been a great fun.
All right. Thanks so much. I really enjoyed it.
Thank you. Thank you. So guys and girls, again, before we're going to go, one thing that I wanted to ask you, if you share this episode with a friend of yours, that friend who always, talks about real estate investing but never pulls a trigger, I think this episode will bring a tremendous value for that person from active, passive side. So make sure to pass this episode along. And thanks again, Jason, for coming over. And as always, I'll see you next time. Thanks for watching.